welcome to this tutorial brought to you by To The Tick. Today's topic is the bearish rising wedge. Now, rising wedges can be seen in two main areas within market structure: trend continuation and as a reversal. It is important to note right now, however, that rising wedges as a price pattern are considered to have a definite bearish bias whenever you see them. So today we're going to focus on recognizing them, what do they look like, and then how do we want to trade them, and we're going to choose the bearish trend continuation setup to focus on today, as it offers us really high odds that the pattern leads into more of a bearish trend. So the image that I'm going to put here now represents a bearish trend continuation pattern, and it's important to note that it comes in two parts. The pole, which is the base, is up here, the pole length, and you'll notice it's tilted, and then we have the tip of the pole pointing straight down. This means that it is representing a bearish trending pattern. The actual rising wedge itself here could be considered either neutral or even possibly have a bullish bias just off of its shape alone, and that is part two of the pattern. It takes both parts, but the part that makes it a trend continuation is the pole. So therefore you have no continuation pattern without a pole, and that pole is what defines trend. So today we're looking at bearish trending action. We want a bearish rising wedge to show us how we can get into a continuation of trend. So we're going to watch the pattern unfold bar by bar, because we don't get to look at those pretty little images, and we need a reference point to start, and it's up here in the upper left corner, and the bears are hammering themselves into a bullish base of support, and we need to see them finally get enough juice and gusto to break through there. Break those price action and then hold that as a breakdown, and we go watching those bears stomping down that hill. We get to watch the creation of the pole. Notice the pole base is where you broke down. Your pole length is tilted just like prices normally do. That's why it's tilted. And then you come to a pole tip. Now the pole tip coincides with your swing low and your price action. That doesn't necessarily mean the trend is over. It means this is where somebody was willing to step in and buy. Maybe they're just buying to cover to take some profits. But the point is the decline has stopped, and this is where it is with your swing low. Then we get a bar that's a pull up to a swing high. We get another swing low, another swing high, another swing low, and we now have enough of a picture here with enough points to use as reference to outline an immediate level of support on the bottom and an immediate level of resistance on the top. Now the first thing you're going to say is those are tilted the same direction, and yes, we want to come back and let's look at our little image and say, okay, part one was the pole. Part one we got to watch. We wanted the bears to come in really strong, really volatile, really impressive with their thrusting move downward. The deeper and wider your price spread in that activity, the better, and part one is complete. We can now have the pole go away. It's complete. However, we're going to continue to use that pole, and I'm going to show you how, but let's look at part two. I slid the image over here so you could say to me, Lav, wait a minute, that image is not filling in the space the same way my support and resistance lines do in my current price pattern. It's okay. The point is the shape will be slightly different. The amount of time that you're going to be spending in here, the amount of spread that you have inside your support and resistance line may be different, but is the structure the same? What is that structure? We are making higher lows on each pullback, and we are making higher highs. You're going to go, wait a minute, that's the definition of an uptrend. Well, yes, it is. Higher lows and higher highs is the definition of an uptrend. So what we've got here is in the immediate picture during the second part of our pattern of a bearish breakdown and a bearish continuation, we're watching part two of our pattern showing us an uptrend. prices in an uptrend? Well, it's the immediate situation and not the big picture. And again, I cannot stress enough the importance of understanding the pole and understanding the creation of the pole and who's in charge when that happened. So we look for this part 2 phase here that we're in right now to be what's called a consolidation. Let's see them take a pause and take a breather. We're going to see buyers stepping in and sellers stepping in, and the real key to this pattern is that you'll notice that the support line on the bottom is at a real steep incline. The slope of that lower line is very exaggerated, very sharp. The upper line is not so sharp, almost flattening really, and it's representing the efforts on the high side. So again, that part of the picture and being able to understand what that means is that your prices are squeezing and yet they're still staying inside this range-bound scenario. So as we continue to keep building our pattern in here and we get a little more time and another bar, another swing up, another swing down, notice how it's still respecting the lines. Oh, sure, you might get a poke or two through it, a poke or two through it. Again, technical analysis is more of an art form, and there are going to be times when you'll have these little pokes in here, but does the structure maintain itself? Yes, that's exactly what happens. And as traders during this consolidation phase, we want to see overall the volume declining. We want to see much less volume involved in this phase than what we saw when they created their pole. However, every push into your upper resistance line, we need to see that those buyers pushing it, and then it's met with a reaction of selling. Every single time they might thrust that volume from those buyers, and then it's met with more selling. And the bottom line is you've come to an area where somebody has to win. Everything has squeezed so tightly into an apex that something has to give. Now for the aggressive traders, this particular pattern is more difficult to trade than most bearish continuation patterns. And the reason is because you've got that ever increasing higher level of support coming in there, and you keep getting your profit potential squashed. However, aggressive traders can work with that angle, watching for that upper resistance angle to start flattening out, and most important, pay attention to your background activity. Every bar in your background will offer a challenge. If they manage to keep pushing through a little bit, you're going to keep raising the bar. However, when prices approach your support line, respect it. If you need to see momentum stepping back in out of those buyers, take your money and try it again or wait. The more traditional way to be looking at this pattern is to wait for them to firmly break that rising pattern off that lower level of support, break it, and make sure they've broken it the same way we did up here in our first breakdown. That's what we want to see them doing again in order to get that confirmation that we've really gone into a continuation pattern. Okay, so right now as we watch them go back and forth, we call this area, as those prices keep squeezing, it's called an apex, just like it is in a triangle. Those of you that are familiar with triangles, this is a triangle. It's what it is, and it's still attached to the pole, and it's still got a breakdown level that's on that lower level of support, and those apex squeezing those prices, and we're going to look for a reaction as soon as they manage to get that break. Now, as aggressive, and again, aggressive and not so aggressive traders, there are several different ways to try to target this. So the first target, which would be a little more conservative, would be show me the repeat effort on the swing low. We had a big breakdown from you, bears. How strong are you? Number one. Number two, we could actually take a measurement of the swing low of our rising wedge and take the swing low to wherever that swing high finally tops out. And again, you won't know exactly, but you're getting a pretty good idea with that flattening upper resistance line. You're going to take that number and subtract it from the breakdown price, and that'll give you a target. And notice in this example, there's not a whole lot of difference between those two. Now, less aggressive, you could be working each one of these stair-stepping lows in the pattern that created the wedge, and that would be a less aggressive option to be able to still trade this pattern. Now, the most aggressive person says, wait a minute, I think this is just the first leg of a great big continuation pattern. My larger charts are telling me there's more coming, and everything in the price action and this consolidating volume and the bears taking over in here. If they do that, you're going to see a surge again in volume and a push in price, and you're going to take a measurement from your entire pole. Yes, I mean the entire pole from the base to the tip, and you're going to subtract it from this apex. And from this apex, you're going to give yourself a great big repeat pattern target. Now, those would be both the conservative as well as the aggressive ways to look at the pattern, but it's important for you to understand that ultimately somebody has to win this battle. And this particular pattern, like I said before at the very beginning, has a definite bearish bias. Some folks will even try to give you percentages on how often. In a bearish continuation trade, we're looking at something like 70% of the time it is going to come down again. Okay? It doesn't tell you which one of the targets, so trade accordingly. Now, upper stop placement on all of this should be fairly tight, and I would use the resistance that's outlined for you in the background, i.e. each one of these bars and or that initial breakdown that got us here in the first place. Ideally, the consolidation phase is fairly short, 2 or 3 swings in order to justify the pattern. We need at least 2 or 3 swings, and sometimes it might go on, in your particular chart, it might go on for 6 months. So again, it's all about the prices still holding the structure. And again, it's higher lows and higher highs in the pattern, with that top line getting increasingly flat and the prices getting increasingly tighter in the apex. So let's go ahead and watch and see what happens. And I can tell you that also with a huge percentage of time, the breakdowns and bearish continuation patterns will get a retest. You will get a break through this lower support line, and then they'll come in and try to say, prove it to me. Often there's a delay in volume there. You get the retest, and then all of a sudden, bam, the volume comes in really hard and you go racing. Again, take some profits if you feel like it's taken too long. Move that stop placement down. Everything can be aggressively lowered once you're in the trade based on the price action. You want to see them continue to keep coming with it. You want to see every failed effort now from the buyers to do anything, and the bears just totally take over and the selling side of the picture. We've gone from part 1, which is your pole creation and that thrusting deep volume, thrusting activity and volatility. We want to see it get repeated. Part 2, the consolidation phase, actually creates our rising wedge, which by definition is an uptrend picture, but it's happening inside a bearish breakdown. So therefore, now we have our 3, and that is our bearish continuation pattern. In summation, it's important with this rising wedge that we realize the pole, that bearish pole, is the thrust in volume and price, and that first aggressive, impulsive action. We want to see it hard and fast and deeper, the better. Higher spread in prices, the better for us, looking at it as a possible continuation of trend for something that we can participate with after that pole is created. We want them to do it again. Okay, then we look for that consolidation phase to be the shape of a rising wedge with those higher highs and higher lows. We want to watch those converging support and resistance trend lines, and we also want to see that apex, that squeezing prices really tight. We want to see that new breakdown, and in that area we want to see a new push in volume out of the bears. And then our target options for this pattern are the apex minus the measurement of the pole, the breakdown minus the measurement of the wedge, and or stair step down, retest each swing low of that wedge pattern and or your pole tip. Now, I thank you very much. That does complete our tutorial today on the bearish rising wedge, but I wanted you to know that on the website tothetick.com I always have the text, the videos, and then also live chart patterns for you to review as well. You'll notice the notations and things are all about what we talked about today. We talked about volume, we talked about where and how to be looking for our different targets, and it's all here, so come look. And I usually offer one or two, try to give you a little mix, and this one was over 2 days, and I kind of like this pattern so that you could see that continuations have a pattern, have a tendency to keep coming and keep coming and keep coming, and the patterns in volume and things keep repeating. So again, this has been brought to you today on the bearish rising wedge from tothetick.com/edu. Come subscribe. We got lots of great things for you, and thank you. I'll see you again.